Good morning, good afternoon, good evening, and Happy New Year, traders from across the globe. Welcome back to work, trading in 2022. It's going to be a busy year. Rates are going to move. It's going to be a long year of a lot of work, kids, so get ready. But boy, am I glad to be back. Wow. I hope you guys are glad to see me, but I am glad to be here in front of you. This video, first video in 2022, coming at you on a Tuesday night for trading, Wednesday, Jan 5th, 2022. As always, we address the risks behind trading. You know they're there. Never trade without stops, ever. No markets. I don't care if it's futures, options, stocks, you name it. Put those stops in. Put your protective stops in first before you even get into the long or short position. And never trade without them. Let's get moving. All right, so a few things on the board. First off, let me bring your attention to this chart. And traders, how about the OMNI call once again for 2021? So in the beginning of 2021, I do my magic call like we do every year, the OMNI call. We've been graced with getting it right since 2007, my goodness. So in the beginning of last year, we were trading at about 36.50, 3,700, right around there in the beginning of 2021, the end of 2020. And I conjured up my projection. And for whatever reason, for 2021, I got two projections, which doesn't usually happen. First projection was for 42.60, and I said I'll put that on the board. I'll also put my other projection on the board, just in case we get past 42.60. I'll then release the secondary one. Now, I wanted the markets to somehow miraculously move 600 points in 1 year, S&P, and go from 36.50, 3,700, up to 42.60. So that has to happen by December, right? We got the time frame here. By December, we should be at 42.60. The year starts off, the market gets strong, and lo and behold, by June 18th, we hit 42.60, middle of the year. So then I released the secondary target, which was this insane target of 5,400 in E-mini S&P. That's expecting me, some madman, to be right and say that the S&P is going to go from 36.50 and move up 1,750 points and go to 5,400. Insanity, right? Well, first target was hit, no problem at all. So we already made our year-end target. Second target, if you look at this, 36.50 is here, 5,400 is here. It went this far. It only had to go that much further to hit 5,400. It got to 4,000, got to 47.99.75. So it got to 4,800 from 36.50. So it probably will make its way to that 5,400 mark. But wow, was OMNI on the money again, right? So this year, I haven't even began to conjure up the 2022 call. A lot of analysts out there post their calls like already before the year is over of 2021. I don't know how anyone can do that. Because for me, I've got to see where we were, what we did, where it ended, and then I begin to figure out where we're going to go next. So 2022 call will be coming soon. I'll conjure it up in the next couple of weeks, and then I'll decide when to give it to you. What else is on the board? Let me bring your attention to number one. We have mixed signals for day trading on Wednesday, the 5th of January. OMNI is giving me all kinds of crazy buys, sells, neutrals all over the place in S&P, NASDAQ, Russell, Dow, Transportation Average, you name it. So I think one more day I may stay away. We'll see what happens. But there are other money trees out there, and I'm going to go for them on Wednesday, and I hope you join me. Now, we've got a lot of work ahead of us, traders. What I think will happen here, and I'll show you some charts in a moment, is this. Not what I think will happen. This is the inherent relationship between markets, real estate, and interest rates. They are getting ready to raise rates in the next 3 months. The market is noticing already, and bonds are tanking. When bonds go down, interest rates go up. Whether you know it or not, we do not need the Fed to raise or lower rates. Traders can move the bond price and make rates move. Now, The Fed's been buying bonds forever to keep the price of bonds up, keeping rates down, and traders had no chance of fighting against the Fed. Well, the Fed is backing off on their bond buying, eventually stopping the bond buying, and then maybe raising rates, which makes bonds go lower. Now, if the street, the banks, all the traders in the world decide to just sell bonds, the rate will go up automatically, whether or not Jerome Powell flips a trigger or not. That's how this works. If bonds go down in price, the bond futures, interest rates go up. Now, of course, the Fed raises and lowers rates, and how they keep them in check is by either buying bonds or selling bonds to make sure the Fed rate doesn't move too much. But if they're not buying bonds, which means they're not selling them, but they're no longer buying as many, if the street sells more than the Fed's buying, bonds will go down and rates will go up, and I'll show you some charts to prove that. Now, if you are buying real estate, here's good news. Rates are really cheap. If they raise rates, it doesn't matter. They're going up a teeny bit. It means nothing to you except for this. It will be, and we'll discuss this again when they get closer to raising rates. When they go to raise rates, this is called the get off the couch segment of interest rate movement. That is any company or any individuals, let's forget companies, individuals, you and your wife, husband, whoever, you're sitting there on the couch and you're deciding we should buy a house, interest rates haven't moved in so long, that's not a worry. The price of the house fluctuates a bit, we can kind of afford it, but there's no urgency to go out and get it. And then suddenly you hear that they're going to raise rates. What do? You get off the couch and you go buy that house before they raise rates and your mortgage goes up. Now let's go to companies. Big corporation, they're looking at buying a big property. If the rate moves a little, the payment moves a lot. So if they are going to raise rates, it buoys real estate. It makes it go up. While at the same time, it makes the stock market have to adjust down in price. Why would that be? If the stock market's made up of corporations, big, huge ones, those corporations sell forward corporate bonds, monthly bonds, quarterly bonds. So you give money to a big company, Goldman Sachs. They use that money for a month to pay their monthly overhead and run their business, and they promise you X amount of interest of return at the end of the month. Those are monthly bonds. Those are how corporate bonds are sold. If at the end of the month of the quarter they owe you 5% interest, great, you get your 5% interest. That's why you would buy a corporate bond instead of a U.S. bond that has low interest. Well, if U.S. bond interest goes up, the 10-year, 30-year, the interest that you get if you buy a bond goes up, well, these companies then have to offer more interest for their corporate bonds. That means they're paying more money for the same amount of money, which means their stock feels it in price and must adjust. In layman's terms, I hope I didn't confuse you, but that's what will happen. When they start to raise rates, real estate will go up because it'll give it a boost, and the stock market will have to adjust down a little bit. So that will come in the future. We'll discuss it again. Get ready for that long-term. Short-term, very mixed signals. We're going to go after some other markets. I want to show you some charts right now to sum up what I just spoke about. Remember this. Keep your emotions out of trading and say this to yourselves every morning, every afternoon, every evening. Then we'll look at some charts right after this, and you know what that is. Stops are in. Emotions are out. Traders, let's go look at some charts. Okay, traders. E-mini S&P, if you ask me, that looks pretty good. Looks kind of strong. Looks kind of bullish. Looks like a bull flag. Nothing wrong with that. But OMNI is kind of wavering a little bit. And then I look at NASDAQ, and this looks exactly opposite. This is the bar for Tuesday. Settled at the low. If that was a flag, it's breaking down lower than it. So this doesn't look at all like the S&P did, right? So this one looks opposite of what S&P looks like. Then you look at Russell, and it's nowhere near where the S&P and NASDAQ are. It's all the way down here, and it's below the average, and I'm just going to leave it alone because my OMNI arrows look like this, and like that, and like this, and they look like that, and they look like this, and they're all over. So we're going to leave the indices alone. Let the OMNI figure out what it wants to do. Maybe Wednesday night we'll play those. But let me show you what's going on right now for slightly longer term thinking, not just tomorrow, but the next couple of days, weeks out. These are your 30-year bonds. They are dropping very quickly. When bonds go down, interest rates go up. This is interest rates going up right now, watching that bond chart go down. Now, you've seen this chart in many videos. Let me see if I can explain a little bit more about what's happening here. I've been showing you this chart for a couple of years now. In videos, from time to time, I break it out, and here's what it illustrates. These are our 30-year bonds on a weekly chart. We were in a bull market for years in bonds, and interest rates kept going down and stayed down, and then bonds had this capitulation, which we called it that exactly on this day. We put this blue box there and said this is either a blow-off top or capitulation, call it what you will, but that's it for bonds. Well, since then, bonds have started a downtrend. Now, when bonds were in the uptrend, it's a bull channel. If bonds are going up, interest rates go lower. Right? So while we're in the bull channel, good job. Well, now we're in a bear channel, the red one, and while bonds are going down, it forces interest rates to go higher. And we are at the always watched by the street infamous 200 bar moving average right now, and bonds are sitting right here below that average. Last time we got down there, they saved themselves and went back up. I kid you not, if we break that and hold a few days, they will come murder this thing, sending interest rates even higher. So get ready for that. In the beginning, it'll help real estate. Don't let that scare you. It will probably make the stock market adjust this quarter. We'll deal with that one day at a time. Traders, if you need more information, join me at livewithoscar.com in my free trading room. I will see you there.